All right, so we are starting from the consolidation, and hopefully you can, all of you can see the screen. Consolidation. The idea of the consolidation is that there is actually a group of companies. There's a parent company who is the holding company, and then there are the subsidiaries. But obviously in F7, in the question, you will be having only a single subsidiary. So there will be a parent company, which is the holding company. Why we call that company as a holding company? Because that will be having the shares in the other company. So parent company and the subsidiary company. The meaning of the consolidation is that you are going to consolidate the financial statements of the parent and the subsidiary. Why we are doing this consolidation? Because first of all, it's a requirement of the company law that the parent entity should present the consolidated financial statement, or the parent entity should publish the consolidated financial statements. So this is the first thing that why we are studying the consolidation, because obviously you will be working in the finance department, and obviously if you're working for a group of companies, and if you're working for a holding company, then you need to know the consolidation as well. So consolidation is actually merging the financial statements of the parent and the subsidiary. So consolidate means merge the financial statements of the parent and its subsidiary. Why we are doing the consolidation? First of all, I have already said that the company law requires the parent entity to publish the consolidated financial statements. That is why the parent entity will be preparing the consolidated financial statements. The second concept is the single entity concept. When you were dealing with your basic accounting knowledge, you studied the separate entity concept. The separate entity concept was that business and none of the business are two separate entities. This single entity concept means that, for example, if there's a company which is a holding company or the parent company, and they hold the shares in another company and they have the control, and they will be doing the decision making of that company. So that means principally it's a single company. It's the same company with the different names. Like say, for example, if I have a company and I have another company and I'm holding that company, I have the control of that company, and I do the decision making of both of the companies, that means it's basically, principally, it's a single company, and that is known as the single entity concept. Although if you see from the separate entity concept and from the taxation point of view and from other point of views, these are two separate entities. And obviously they will be preparing their separate financial statements as well, because even in order to prepare the consolidated financial statement, you need first of all the individual financial statements. So parent will be preparing the individual financial statements, the subsidiary will be preparing the individual financial statements, and after preparing those individual financial statements, the financial statements will be merged and will become the consolidated financial statements. So this is the concept of the consolidation. Now, can we classify every company as subsidiary? Like say, for example, I have said the parent company or the holding company holds shares in another company. So can we classify every company in which the parent has shares as a subsidiary? The answer is no. We cannot classify every company as a subsidiary company, and for that you have the classification chart. So first of all, you need to understand the classification. The classification chart. When to call a company as a subsidiary, when to call a company as an associate, and when to call a company as simple investment. So if the parent has more than 50% holding in a company, then that company will be called as the subsidiary company. If they have 20 to 50% shareholding, then that company will be called as an associate. If they have less than 20% shareholding, then that company will be a simple investment, neither subsidiary nor associate. Moving further, when there is more than 50% shares in a company, then that company is known as subsidiary and the parent has the control. Control means that you are actually having the governance. You will be governing that company. You will be deciding their financial and operating policies. And if you remember the basic concept of substance over form from your previous studies, if you remember, substance over form was like, for example, there are two things. One is the legal form and other is the commercial substance and economic reality. And control means that you have the risk and rewards. So when we are saying that this parent company controls the subsidiary, that means parent will enjoy all the rewards and bears all the risk associated to that subsidiary. And they will be the one who will be doing the decision making. They will be hiring the board members, they will be firing the board members, and they will be doing all the major decision making within the board. That is known as control. And like at the FA1 level or FA2 level in the FIA, I do teach a concept of like what is the difference between own and control. Own is something related to the ownership. It is not necessary like, for example, if you have the ownership, you have the control as well. Because like say, for example, if you buy a car from a bank on lease, till you make all the lease payments, the legal owner of the car will be the bank. But obviously you have the control, you have the risks and rewards from the very first day. If something happens to the car, it will be you who will be responsible. You will be enjoying all the rewards and you will be bearing all the risks. So control is something, risks and rewards. And in terms of companies, it means the decision making, the governance, deciding the financial and operating policies of an organization. When you have the 20 to 50% shareholding, then that is an associate. And that gives you the significant influence. Significant influence means that you cannot decide their financial operating policies, but you can participate in their financial and operating policy. You may have your influence, but obviously you will not be the one who will be the decision maker, but you can participate in that decision making. That is known as the significant influence. In the simple investment, when you have the less than 20% shares, then neither you have the control nor you have the significant influence, and you will be having the simple voting rights according to your shareholding. So if this is the case, now what will be the treatment? The treatment is simple. If there is a subsidiary in which you have more than 50% shares, that gives you the control, and you are going to consolidate it. Consolidate means that parent plus subsidiaries financial statements will be merged. If you have the 20 to 50% shareholding, that means you have the significant influence. Significant influence means you can participate in the financial and operating policies, but you do not have the control. If you do not have the control, that means you cannot consolidate it, but you will be performing the equity accounting. Equity accounting means that we will be recording one figure in the statement of financial position, another figure in the statement of profit and loss. And how to calculate that thing, we will be studying that later on. In the simple investment, because you neither have the control nor you have the significant influence, you have the simple voting rights. So you will be recording this investment as the financial asset. Simply, it is your financial asset. So what are the main standards that gonna apply? The main standards that gonna apply is IFRS 10, equity accounting IAS 28, and then you have financial asset, which is IFRS 9. So this is the classification chart, and you may have the MCQs from that. First of all, you need to know when to classify a company as a subsidiary, when to classify a company as an associate, and when we'll be classifying as simple investment. Remember this thing, that this thing which we have studied in terms of percentage is the quantitative threshold or the quantitative benchmark. It is possible that even if a company has more than 50% shareholding of the company, still that is not a subsidiary, because there are some instances, there are some exceptions of the control. I have already explained you, like, control is about decision making. If you have more than 50% shareholding and still the decision making lies with someone else, so that means you does not have the control, even you have more than 50% shareholding. So we'll be studying that exceptions as well in the theory. So remember this thing, that this is the general classification chart based on the quantitative threshold we have discussed. And based on this, we will be classifying a company as subsidiary, associate, or simple investment. All right. So now we have studied the classification chart, and we are going to study consolidated statement of financial position. We will be studying consolidated statement of profit or loss. We will be studying accounting for associate, and we will be studying the disposal of subsidiary. So these are the four things, 1, 2, 3, and 4, that we are going to study: consolidated statement of financial position, consolidated statement of profit or loss, accounting for associate, and disposal of the subsidiary. The first thing we will be studying is the consolidated statement of financial position. And before studying that, you need to know the basic principles of the consolidated statement of financial position. So consolidated statement of financial position. Statement of financial position is also known as balance sheet. Balance sheet is actually the financial statement which shows the financial position of the company. And the basic format of the statement of financial position is that we have the assets, in which you have the non-current assets, you have the current assets, and then you have the total assets. The basic format. The basic format is you have the non-current assets, then you have the current assets, and then you have the total assets. And then you have the equity and liabilities. So you have the equity portion, you have the non-current liabilities, you have the current liabilities, and then you have the total equity and liabilities. So remember one thing, that the basic concept is that the total of assets should be equal to the total of equity and liabilities. If the total is same after preparing the financial statement of financial position, that means you have managed to prepare the statement of financial position correctly. But say for example, if say for example, if there's a difference in the total, that means there are some errors which you have made during preparing the financial statements. Okay, now let's come to the basic principles. Remember one thing, that we are going to consolidate on line by line basis. Line by line basis means that we'll be taking the assets of parent plus subsidiary, like non-current assets of parent and non-current assets of subsidiary, current assets of parent and current assets of subsidiary. This is something line by line basis. You are going to eliminate parent investment in subsidiary. Remember one thing that I have already said to you, that when you are preparing the consolidated financial statements, you have the individual financial statements of the parent and the subsidiary. Because the parent has purchased the subsidiary, that investment is actually recorded as an asset in the parent's individual financial statements. So when you are consolidating it, so you will be eliminating the parent investment in subsidiary and you are not going to consolidate it because of the single entity concept. Because if there is a concept of the single entity concept that you are consolidating the financial statement based on that this is the single company, then obviously one company cannot invest in itself. So the investment of the parent in the subsidiary should not be consolidated, or you can say it should be eliminated. But remember one thing, that you have to only eliminate the parent investment in subsidiary. Maybe in the exam, if you have been given the investments, you have to see whether this investment is the only investment which is the parent in the subsidiary, or there are some other investments as well. So if there are some other investments in that investment thing, then you need to eliminate only this parent investment in subsidiary, and rest of the investments should be consolidated. The third thing. The third thing is the share capital and share premium will be recorded of parent only. Although you will be classifying the assets of parent and subsidiary, you will be classifying the liabilities of the parent and subsidiary, but there is no need to consolidate the capital, share capital and share premium. Why is that? Because already you have taken the net assets in terms of assets and liabilities, so there is no need to take the capital as well. So the share capital and the share premium will be of parent only. Then you have an other important principle, which is non-controlling interest. Non-controlling interest. What is non-controlling interest? Say, for example, if you have acquired 80% shares in a subsidiary, that means you have a control. But you have the 80%, shareholding. The other 20% which you do not have is known as the non-controlling interest. Because you have the 80% shareholding, but still you will be consolidating the full subsidiary. Technically, you should do the 80% because you have the 80% shareholding, but you will be doing the full consolidation. You will be consolidating the full subsidiary. So if you are consolidating the full subsidiary, and the rest of the 20%, which is the non-controlling interest, should be presented between equity and liabilities. So the proportion which you have not acquired will be presented in the consolidated financial statement because you are consolidating the full statement of financial position. Then you have another concept, which is elimination of intra-group transactions. Elimination of the intra-group transactions. What does that mean? We have already stated that we are doing the consolidation based on the single entity concept. So single entity means that obviously they cannot sold goods to itself. They cannot make a profit from itself. So if there are some intra-group transactions, such as they have intra-group loans in which they are charging the interest, okay, intra-group transactions, such as they are selling the goods or the non-current assets, such as they are selling goods, non-current assets, and they are making profits which are known as unrealized profit, and we'll be dealing that later on. So these transactions should be eliminated. So these are the basic principles you need to remember. I'm going to repeat it, that first of all, we are going to consolidate on the line by line basis. We are going to eliminate the parent investment, the subsidiary, okay? And we will be recording the share capital and share premium of parent only. We'll be recording the non-controlling interest between equity and liabilities, sorry, and we'll be eliminating the intra-group transactions. So these are the basic principles through which we are going to prepare the consolidated statement of financial position. Now you have this consolidated statement of financial position in front of you. Consolidated statement of financial position. Yeah. And obviously we will be dealing with so many things in this, but today I will be keeping our first lecture a bit short because obviously some more students may join us from tomorrow. But we'll be discussing some part of the consolidated statement of financial position. Okay, the first thing you need to know is, like you have the non-current assets. And in the non-current asset, first of all, you have the property, plant, and equipment. Okay, if you see the property, plant, and equipment, you have the property, plant, and equipment of the parent plus subsidiary, and then you have plus fair value adjustment, and then you have minus fair value depreciation. What is that? Let's discuss these things on a rough work. Okay, so now you have the parent plus subsidiary. So we are talking about the property, plant, and equipment. Remember one thing, that we are taking the book values. Remember one thing, that we are taking the book values. We have the individual financial statements, and from those financial statements, we are taking the figure of the property, plant, and equipment. But it may be possible that these book values does not reflect the actual market values. And the actual market values, mainly of the subsidiary, is different from what is in the books. So that means you are required to incorporate those fair value changes into this property, plant, and equipment. So say, for example, if in the exam it is mentioned that the fair value is more than the book value, then what you're going to do is you will be adding that difference figure within, so the fair value. You will be adding this fair value, which if it is more than the book value. So it will be clearly mentioned in the exam that the fair value is more than the book value. So you will be adding the figure over here. And if it says vice versa, like the fair value is less than the book value, then you will be deducting that figure from here. Similarly, the depreciation is charged on the book value. And if the fair value was more than the book value, then that means there should be an extra depreciation, which still is not deducted. Then you will be deducting that fair value depreciation. So, and if it is vice versa, that the fair value was less than the book value, that means depreciation has been charged more than it should be, then you will be adding back that depreciation. So remember, it works vice versa. So if there is upward revaluation, the depreciation will be deducted because extra depreciation should be charged. If there is downward revaluation, then that means extra depreciation has been charged, which should be reversed and the depreciation will be added back. So remember this concept. So now we are done with the property, plant, equipment. So parent plus subsidiary plus fair value adjustment plus minus, and plus minus fair value depreciation. Then you have the goodwill. So goodwill, what is goodwill? Remember that what you have paid more than their net assets. So if you are buying a company in more than their what net assets worth, if you're paying them more than what their net assets worth, then that means the extra amount you are paying is the goodwill. Say, for example, if the worth of their net assets is 100 million and you're paying them 150 million, that 50 million, which is extra paid, is actually the goodwill. Why the company pays the goodwill? The goodwill is for those things which are not recorded within the financial statements. Like, for example, the reputation of the company, this is not reflected in the financial statements by the monetary amounts. Similarly, their skilled employees, the employees are not recorded within the financial statements. Similarly, the market share they have is not reflected within the financial statements. So the long-term tenure that they have passed, the long-term contracts they have, the customer base they have, the secure supplies they have, all these things which are the plus point are not actually reflected within the financial statements. So the company will be paying for those things, and goodwill reflects all those things. So goodwill is actually what you are paying more than their net assets. Then you will be having investment. Remember one thing that I have already said, that you will be eliminating the parent investment in the subsidiary. Other than that, you will be consolidating all the investment. So simply parent plus subsidiary minus that investment, which is done by parent in the subsidiary. Then you have investment in associate. I have already said that equity accounting, which means there will be a figure which is recorded in the statement of financial position, and there will be a figure which will be recorded in the statement of profit or loss, and we will be dealing that later on. So investment in associate. So this is it for today, and tomorrow we'll be continuing. And for tomorrow class, you need to make sure that you have the hard copy of these consolidation notes, so that you may write as well. But it is recommended not to write within the class, because your focus will be diverted. I'll be providing the recordings. You can write later on, but still, if you can manage, you have the multitasking thing, then you can do it for sure.